My name is Matt Seifer with the Real Estate Finance Initiative here at Georgetown McDonough, and I'd like to welcome you to the 5th edition of the Real Estate Luminaries event, the series here. This is my second actually year of doing this, and by far this is the best lineup we've had top to bottom so far. I'm very proud of this event because it's our opportunity to gather on campus. It's the students, it's the alumni, it's the friends of the program to really to actually come together here at Georgetown under the banner of real estate and really show what is possible here at Georgetown McDonough. So we're so very thankful you're here. We're very thankful for NAREIT for sponsoring us here this evening. Certainly appreciate that. And for the students in the room who are learning this space, I'm proud to say to you today that we have rock stars here today. So these unassuming gentlemen to the left of me right here soon that you're going to learn about, they are rock stars. We have Barry Sternlicht. I'm not sure if you're familiar with him. The guy is a rock star. So you're going to hear from what I believe to be some of the best minds in the business. And in my humble opinion, I don't know if this is showing any humility or not, but there are a few institutions on the planet that could convene this quality of an educational experience and a speaker's lineup, and we're doing it here at McDonough. So, I just want you to be aware of that. So it's my privilege now to introduce what I consider the brightest of the rock stars. I'll call him the leader of the band, Bob Steers. Words often used to describe Bob include visionary, pioneer, and leader, but most importantly in my book, he's a solid dude. Really high quality individual, and I'm thrilled to be a co-partner with him in this initiative here at McDonough. Bob's has a BS from Georgetown University, from the business school, the CEO and co-founder of Cohen & Steers, which is an absolutely revolutionized the manner with which you think about real estate investing, especially from a REIT perspective. More importantly for us today, Bob and a couple other gentlemen in the crowd, Tim McBride and Bob Billingsley, they had an idea that why on earth can't we succeed in real estate here at Georgetown McDonough? There's no reason for that. We're in DC. We have all the amenities associated with this institution. There's no reason for that. And it was those three gentlemen and others who really planted the seed for this and backed it up in every manner of speaking to get us here today. So we find ourselves here after many years of hard work from these guys, and I'm very appreciative of that because they have provided the nucleus from which we're going to build on. And in my, again, humble opinion, this is going to be a position of strength within the school and within Georgetown in a very short order. So with that, I'm going to introduce the leader of the band, Mr. Bob Steers.
Thank you, Matt, and thank you all for joining us today. This year's Real Estate Initiatives Luminaries series is focusing on global real estate investing. Is it a process of elimination? We're fortunate, as Matt said, to have the world's foremost global real estate investors to lead us in what I know is going to be a thought-provoking session. But before I introduce the panel, I want to share a few comments and observations around the initiative that Matt just referred to. In only its second year under Matt's leadership, the program is exceeding all of our expectations. In a short time, Matt has designed a curriculum targeting all four quadrants of public real estate, debt, and equity, which is also reinforced through a focus, and I think this is unique, on a focus on experiential or applied learning. This ranges from Argus training to international residencies and fellowship programs with leading firms like Invesco Real Estate. MSB students this year alone underwrote over $1 billion of live real estate, commercial real estate deals. These students were smart when they got here, but they're ready to contribute on day one when they leave the MSB real estate program. That said, we have a long way to go before we reach our goal of being a top 5 real estate program. For you alums, parents, or friends of Georgetown who are here today, I ask you to consider getting involved. In addition to the programs and events like this, the MSB Real Estate Initiative has an active board with subcommittees that could use your help. For example, today's speakers, Adam Metz and Mike Kirby, are both current parents, and Sonny Kalsi and Ron Kravitz are both distinguished alums. It's a great way to give back. For experienced real estate investors, we have high-quality and well-prepared students that you can hire. One of Cohen & Steers' fastest rising stars is a former MBA here who is now managing our master limited partnership portfolios. There are also classes that would love to hear about your real estate experiences. For you students in the room, especially you finance majors, real estate is the largest asset class in the world, and you should understand it. I think you'll want to, especially after you hear from our luminaries today. There's no doubt in my mind that by leveraging the strengths of Georgetown, MSB, and Washington, D.C., and with your support, the Real Estate Initiative, in short order, will rank as among the top real estate programs in the world. Lastly, before I introduce the panel, I would just like to thank Dean Thomas, who has been a very strong supporter of the Real Estate Initiative, and Matt Seifer and Brian Gill for supporting and implementing this important initiative. So thank you very much, Matt. So now it's my pleasure to introduce three acknowledged real estate industry leaders who also happen to be, as I mentioned, Hoya parents and alums. Starting with Adam Metz to Matt's left. Adam is a managing director and head of international real estate at Carlyle Group. Carlyle manages 10 real estate funds and related investment vehicles that invest in a range of real estate assets in Asia, Europe, and the United States. Previously, Adam was a senior advisor to TPG's Capital Real Estate Group and CEO of General Growth Properties. His son, Harry, is a junior in the business school. Sonny Kalsi is a founder and partner of Green Oak and has oversight responsibility for Green Oak's United States business. He was previously the global co-head of Morgan Stanley's real estate investment business and president of Morgan Stanley Real Estate Funds until early 2009. And if I'm not mistaken, at that time, Mesref was the largest real estate investor in the world.
Maybe for a day.
Prior to that, Sonny led the formation of Morgan Stanley's property business in Asia as well. And finally, Ron Kravitz. I want to back up and point out that Sonny is a business school graduate in 1990. Ron Kravitz, also business school, 79. Is head of real estate investing and a senior managing director of Cerberus Capital Management. Prior to joining Cerberus in 1996, Ron was a managing director at Apollo Real Estate Advisors and a managing director at Soros Realty Advisors Reichman International, which is an affiliate of Soros Management. So please join me in welcoming our panelists, and let's get started.
All right, gentlemen, I appreciate your time. As we think about the globe, and really your jobs is to evaluate opportunities around the globe, not only in the U.S., but abroad. Can you put the U.S. market in context with the rest of the globe, and what do you like domestically on a value basis, if anything? What are you concerned about in the U.S. market and so forth? So maybe start with Adam.
Well, I think one of the things to understand about real estate investing is, you are very subject to the macro forces of the economy. Carlyle's a large private equity firm, and we buy a lot of businesses. And, a lot of businesses that you buy, you could renegotiate a labor contract, you could close a plant, you could change your supply chain management, you could change your CEOs. There's a lot of levers to pull. Real estate doesn't have quite as many. It's, essentially typically a box, and if you want to change the box, it costs a lot of money, and you're typically trying to lease up the box and maximize your rents. But because of that, you're very subject to these macro forces. So if you kind of step back for a second and look at the macro, I think one of the things that's very challenging today in the U.S. is kind of where we are on the cycle. the U.S., basically, took a huge dive in '08 and sometime in '09, March maybe for the stock market, June for economic indicators, things started to improve. And if you think back, I know people have been frustrated with perhaps the speed of the recovery, but it's been a pretty steady recovery where we've had 2% GDP growth. I think we create 175,000 to 200,000 jobs every month. It's been ugly, but the deficits come way, way down. The GDP, I think, is back to or above, pre-recession peaks. The stock market's above its peaks, and we're kind of 5 years into the cycle. No patterns exactly the same as the past, but as people look back, these expansions last, anywhere from, 30 months to 100 months, and we're now 58 or 60 months into this. So I think one of the challenges today in the U.S. is this kind of situation we're in where if you're investing and you're looking out 2 years, 3 years, 5 years, whatever it is to ask yourself, what's going to happen over that time period? Is the expansionary cycle that we're in going to continue? Are interest rates, they seem to have bottomed, and are they going up? And what does that do to exit cap rates? There's all those kind of challenges in today's world just from a macro perspective and what you think is going to happen. And typically it's very hard to predict what causes things to start to go wrong. Sometimes there's excesses in the system. Sometimes something terrible like 9/11 happens, which is very disruptive. So it's very hard to predict what's going to cause it to end, but we all know these cycles do kind of end at some point. So I think it's very difficult from a macro point of view. From a more granular point of view, I think when you look at the supply side, it generally feels pretty good. I think everybody in real estate says, except for multifamily, there's very little new construction. So that part of it feels pretty good. And there's certain kind of changes that are occurring, whether it's sustainability and adherence to environmentalism and a lot of those concepts that people are demanding. Law firms and a lot of fire industry firms are changing the way they use office space. Obviously there are less assistance with the internet. There's less law libraries and all these kind of things. So there's some secular changes that are going on that cause different needs of real estate. So a certain amount of real estate does become obsolete, and with very little new construction, that should be a kind of a healthy thing. But having said that, the demand side could collapse at some point here, and I think that's kind of worrisome. So, gentlemen?
I think the U.S. is the tallest midget in the circus, right? So if you think about things on a relative basis, right? I mean, I like to think of myself as a value investor. The one time probably in my career I wasn't a value investor. I wish I had been in '06 and '07, right? When there was the last time that I can remember where you could find no value in the world. I don't think we're quite there yet, but there's a lot. When you're investing, you want to find reasons to do. You're looking for reasons to be excited, right? And I think with the U.S. right now, the biggest argument I can make for investing in the U.S. is there are a lot fewer reasons to be nervous about the U.S. than there are some of the other things that are in the world. Ron can talk much better, much more in depth about what's going on in Europe right now than I can. Look, you invest in Europe because it feels cheaper than the U.S. You don't invest in Europe because you're excited about it, right? If you think about Asia, I personally, spent a lot of time. I lived in Asia for 10 years. I was an early investor in the emerging markets. I'm not interested in the emerging markets at all right now because I don't think you get paid for the risk you take in the emerging markets. So, it's a tough time actually right now to invest because you don't feel like you have a lot of tailwind behind you because you feel good about the economy anywhere. You feel good about growth anywhere. You feel like you're going to be able to buy an asset and fix it and increase rents. You just don't feel great about that. Yep, because of all the quantitative easing that's going on and because of all the capital that's out there, it's hard to really feel like you feel excited about the value proposition when you're buying something. So I actually think to me, it's a very nervous time. I'm a perpetual capital raiser. We're raising money right now, and I'm actually telling my investors, and maybe it's not the right fundraising strategy, but I'm telling them, I'm having a hard time seeing what I'm going to do in the next couple of years. I actually have much more visibility in my mind of what I'm going to be doing 3 years from now. which is buying a lot of multifamily in the US because too much is going to get built, buying hotels in New York, buying hotels in South Beach in Florida, maybe buying office buildings in Texas, right? You just look at where the supply is coming, and there will be a buying opportunity. Right now, it's tougher.
Ron?
I actually agree with Sonny. I mean, I think the U.S. is priced to almost perfection. It's past peak pricing of 2007 in many cases. There's so much capital available, both from a debt and equity standpoint. I think, to throw out a good stat, I think there's over 60 groups either have raised or are about to raise a debt fund. So all that's doing is creating a lot of competition and nice spreads to be a buyer. But the real problem is, even when you're the buyer, the prices keep going up. The cap rates are down. You have interest rates at historic lows. And you've probably seen them bottom out, and they'll probably start moving up if you look at the forward curve. Having said that, the U.S. is a tough market. You have to be very judicious. You have to be very disciplined. And at least from our standpoint, we don't get paid to put out money, just to put out money. So, you know, I'd rather not do deals than throw money out the door. And I think our history has shown that. So we spent the last 4 years particularly focused on Europe. We've put out close to $5 billion there, mostly in NPLs and distressed assets from the banks, because there's a substantial amount of capital problems in the banks and the systems in the 28 jurisdictions in Europe. We focused on 5 major markets where the rule of laws were very much like the US, where you can get to assets. So that would be like Germany, that would be the UK, that would be Spain, that would be Italy, and that would be Ireland. And in fact, it's been pretty public. We just tied up a big portfolio in Northern Ireland, close to $2 billion. So there still continues to be opportunities, but you know that window is closing quickly. And you know, the capital markets have opened up again in Europe, just like they have here in the U.S. Probably maybe 3 years behind, but we're seeing it. We had financing on our pool. Financing when we did this started in 10 and 11. It was L plus 7 and 5 points to get the financing. Today you can get it down into 3s, L plus 3s, and no points. So that just goes to show you, you know, how much liquidity is back in the market. There's still a lot of a cleanup to do in Europe, and so we'll continue to focus on that, but it is getting very competitive.
Yeah. Can I mention one quick thing? And I guess I disagree a little bit with what Sonny said. In terms of my perception, it's good to have a little controversy.
Oh, yeah.
Sure. For sure.
You got the right group here.
You know, there's some people who are dedicated U.S. investors, dedicated Asian, dedicated Europe, what have you. Assuming you're a global allocator of capital, you have to put your money anywhere. The way I kind of see the world today, for those global allocators, is U.S. is mid to late cycle. Interest rates are low. Interest rates are going up. They're artificially low because of QE. U.S. doesn't feel like there's great value, even though there's great rule of law, transparency, liquidity, what have you. You go to China. China's kind of going through this transition right now. You know, the government there is trying to crack down on this kind of shadow banking system. They're restricting credit. They're trying to improve capital allocation, create moral hazard. It's a very tough environment to invest in. The currency was appreciating, now it's depreciating. China, you know, it's a tough time because they're in this kind of transitory period. You know, it's a new government and they're changing. And they're also having a war on corruption. So people you were dealing with you thought were okay are now on the outs and going to prison.
Or dead.
Or dead.
Yes. So China's a very difficult place to invest. Japan, Abenomics, it's a total experiment. Who knows if it's going to work? You know, stagnation for 20 years, you know, a couple decades. Now they're trying to inflate asset prices, which is good for real estate. But the currency's going the other way. They just had a tax increase. You know, it's just not clear to me when you're investing in Japan today if you really know what the macro outcome's going to be. Brazil and Turkey and some of these other Indonesia emerging markets are scary. You know, everyone was excited. Now they have this kind of catch a falling knife feel to them. I mean, you don't really feel they're at the bottom. So as you're looking around, you're kind of saying, and this is where I agree 100% with Ron, it's like, the Europe, instead of having a '09 moment, they kind of bumbled along. There was a euro crisis, and next thing you know, they had a double-dip recession, and it looks like maybe their turning point was 13. The fundamentals still aren't great, but they seem to be pointing in the right direction. So all this global capital is sitting there and said, Europe's got its problems, don't get me wrong, but of all my options, I kind of feel Europe's in this kind of early stages of recovery. I'm comfortable. A lot of global investors are very comfortable in London, comfortable in Europe. It feels, similar to the U.S. in some ways, Western. And so there's all this capital that's kind of said, there's better value in Europe if you believe in the recovery. And I think what's happened is it may have been overdone now. So you go to Spain, and Spain had 27% unemployment, which is horrific. The numbers can't be right.
Still is.
But now it's 26. So everyone's like, things are improving in Spain, so all this capital rushes into Spain. Ireland, a year and a half ago, was the same way. They made some reforms, took the pain, and things started to improve. And next thing you know, people are buying assets. And it's a very small market, Ireland. So all of a sudden, things are going up. So you wanted to be in Ireland. Hopefully, you've made a good buy. But the real time felt like 18 months ago or something to me.
Yeah.
So to me, and hopefully it ends well for these investors, but it feels like the place, the global allocators, the hot spot today is Europe, in my mind, because these other things just are less attractive on a relative basis.
I was on a panel at PRIA, which is the industry conference for the pension funds, our investors, basically. And I was on a panel with somebody from Blackstone, somebody from Starwood, works with Barry, and another fund called Orion. And all anyone wanted to talk about at that conference was Europe. No one could care less about the US or anywhere else. It was all Europe the whole time. So we spent the whole time basically downplaying the opportunity on the panel, right? Because who needs more competition? And we've seen the competition flow in, and and it continues to fly in every day. So Spain particularly is the hot place, as Adam was alluding to. But it's pretty tough.
The other thing I'd say about Europe,
still provincial.
The U.S., even though someone from Texas is different from someone from Boston, it's generally fairly homogenous. We all get up, we watch the same TV shows, we watch the NBA playoffs, hockey, whatever. It's very homogenous. You go to Europe, there's these huge cultural differences. Germans are just different people than Italians. And the French are very different. So even though we're all generalizing about Europe, there's not really one story throughout Europe. And so, everyone who does well in Europe has, foreign nationals working for them who...
That's what we do.
Yes.
Well, that's been our history. When we went into Japan in the 90s, we typically do exactly what Adam is alluding to, because to the point, you got to have somebody on the ground. They want to deal with people, no offense to anybody in the room, that are like them.
Yep.
It just is.
Right. But, investing in France is a total different deal than investing in UK.
Well, there is no rule of law there, so.
So Matt, do you want to rein this back in? Or what do you want to do?
Well, no, this is great. So where I was going to ask is, so I think you just bought a portfolio of retail properties in Spain.
Yeah.
An equity position in the investment.
So it's my first so everything we've done to date has been US, UK, and Japan. So it was my first emerging market investment. And when I make that comment a couple of the Spaniards on my team got very upset that I would call Spain an emerging market. And I said, well, it's really more like a submerging market. So you should be happy if it starts emerging again. So we worked on the deal for a year and a half. We had like 20 people try to steal it from us, right? Which maybe I'll wish at one point that they had. But it's 8 shopping centers from a Dutch REIT that was a seller, public company. So they put a price. Here's the funniest story about it. They said, you can't talk to the press. We're going to put out a press release, and you can't comment until it closes. So because they're a public company, from the time the contract signed to closing was like 45 days. The press release said, These are the worst state assets mankind ever created. We're so happy to get rid of them. They're all pieces of shit. We're so right. And so you have to understand context for why they felt that way. They had 600 million euros invested in the assets. We bought them for 160 million euros. We bought them for a 12% cap rate on in-place rent, which is down 50%. And we're assuming that that goes down to a 9 before it flattens out, because we're effectively assuming that we're going to have to give a ton of concessions and other stuff. So we actually don't, in a 5-year hold, ever assume top-line rents go up. We just assume we can get concessions down, right, which takes a 12 to a 9, kind of back to a 10, right? So we bought them cheap. They're mostly almost all Carrefour anchored, so they have a good, hypermarket anchor. But it took us a long time to get it closed because we had a recalcitrant seller, tough market. We had 3 different lenders fall through on us. We bought it all equity. It's 160 million euros. It's a lot of money. It's a lot of money in real money, right? So we'll see. Look, I'll tell you in 5 years. We definitely bought it cheap. Yeah. Whether we bought it cheap enough or not, I don't know. We'll know in 5 years.
So is it it becomes to some extent a basis play, because I'm sitting here thinking, how the heck do you underwrite growth or whatever you call that? How the heck do you underwrite an exit cap rate? I mean, it's just how I feel comfortable in my...
It's totally a basis play, and the IRR was too low in my mind that we pro forma. I think we pro forma an unlevered IRR in the high teens. I don't know. I still feel like we should be getting paid more than that. I think part of the issue I have with Europe, honestly, is I actually feel in some ways it's equally, if not more competitive than the U.S. is these days, because there are so many people there competing. And from all kinds of different angles, right? A lot of people who you'd not have traditionally thought of as real estate investors are now very actively involved there as real estate, buying real estate assets, because the capital's been raised and they're going for it.
Yeah. It's interesting. We all kind of struggle with that because I think that's exactly right. And I think Ron's business in particular has gotten very tough with all these kind of non-real estate players. It's very easy for a hedge fund who's looking for yield to go buy a Spanish, NPL portfolio or something, and they do kind of a desktop underwriting and they're done. And they're making all sorts of bets, and this is just one bet, and they don't do a lot of work. My view, what happens, one of the mistakes you can make in an up market is look back and say, I could have bought it cheaper last year. And if you really have conviction that a market's going up, if you paid 5% too much, if the market's going up 20 or 25% a year, you should be fine.
But Adam,
I think that's the problem, though, is the market going to go up 20 or 25%?
Well, that's the issue I have with Europe, is that it's hard to have conviction that the market's going up, right? Yeah. I think that I would bet on us being the U.S., all of us, that we can get our act together, right? Because of all the reasons you mentioned. It's one country. It's not multiple, look, I grew up in Tennessee. It's a very different place than New York, where I live now. But it's still one country, still one legal system. I feel, look, one thing for sure is happening around the world is we're going to have regime change going on around the world, right? I mean, we're going to have regime change, whatever direction it goes here in the next couple of years. It's happening in Europe, right? Incumbent politicians are getting kicked out. It happened in China, and there's a whole very different sort of leadership in China. Personally, I think China is going to be really interesting as an investment opportunity in the mid to long term. I think it's really scary right now. Biggest issue with China, it's very simple. The thing is, if I said I'm going to put up a flag and I'm going to go raise a China fund, I could go raise $1 billion very quickly because, unfortunately, most investors are driven by consultants who are usually 6 to 12 to 18 months behind where they should be in terms of the advice they give. And the issue with China is they don't need your money, right? If you guys read about this, you read about trophy assets selling around the world. Who's the number one buyer of all of them? It's the Chinese. Why? They're trying to get their money out of the goddamn country, right? And it's not a convertible currency, so you have to get permission or you have to steal it somehow and get it offshore to be able to launder it, right? So why do you want to put money into a country where everyone else is trying to get their money out? That's actually a very simple lesson that I kind of think. Now, when you think about that, right? I don't know. Look, so I actually think longer term there will be a pretty interesting opportunity in the emerging markets, but it's got to be a value proposition. The value proposition's got to be attractive.
So, Sonny, what about all the ghost towns in China?
You know what, Ron?
On the left side of that balance sheet, which is
I think there's way too much. There's way too much. Look, China's biggest issue right now in the real estate market is there's too much capital onshore. It's a roach motel, right? You have all this money onshore, can't get offshore. Its second biggest issue, as a close second, is oversupply, right? And I think that is a fundamental, for a lot of people in this room, especially the students, you've been studying about this. Look, this last downturn was terrible, right? This last economic downturn, I was probably one of the poster children for the downturn, right? And I don't think anyone else got whacked in the real estate industry quite as hard as I did by it. But it was different than most of the cycles.
I don't know about that.
But most of the cycles, most of the cycles we had. Because most of the real estate cycles are, and I predict the next downturn, which is what, and we're all trying to figure out what's going to happen. I think, look, this was the world blowing up. This was the credit markets blowing up, capital markets blowing up, and real estate going down the toilet with everything else. I think we're going to go back to the old-fashioned oversupply, which is what's going to generally screw up real estate markets going forward. It's screwing up China right now. It's screwed up India. I think it'll screw up certain sectors in the U.S., and I think it'll be a great opportunity in the next few years.
But with all the capital leaving these emerging markets, I mean, does that present an opportunity? I mean, is there anything there to that?
You mean to go after?
Yeah. I mean, it's a counter-cyclical play. I mean, everybody's exiting. What?
It would be a counter-cyclical play if it was a seamless flow of capital, right? I mean, the reality is, if you want to put money into China, if you want to take money out of China, you have to go to the State Administration of Foreign Exchange and get their approval to take it out. And if you want to put money in, you have to go to them and get approval to put money in, right? So yeah, I think for sure in a market that's a real that's why in 08 and 09. You should have bought everything you could in the U.S., right, in a market where there's a seamless flow of capital.
So Ron, I want to shift a little bit and talk to the extent possible about the Safeway transaction you guys were involved in, sort of consolidating Albertsons with Safeway, and you have a very large middle market sort of grocery platform.
Is that real estate, Ron?
There's $11 billion of real estate in the combined portfolio, that's for sure.
And so, that space is sort of weird right now because you have Walmart on one side and you have Whole Foods on the other side.
Correct.
So what was the thought process behind the buy perhaps, and what does that space look like in the short to medium term?
Yeah, it's not a true real estate play actually at this point. When we first went in 2006 and bought Albertsons and took it private and laid off a bunch of assets to SuperValue and drugstores to CVS. We took what was left over as a distressed real estate play, basically, and we ended up finding a management team that could operate grocery stores, and quite frankly, we made 5 times our money on that transaction, and that sort of gave us we were left with 200 after selling off 500, and we looked at ourselves and said, well, we did a pretty good job here, and we had a great management team. And one of the things that we do is, most of the grocery business is very centralized. And it's really hard to run something that's consumer-based from Minneapolis, and you live in California, and you don't know what those people want. That's the primary problem. And then 2, you had poor customer service because of the centralization, and you didn't have CapEx going into the stores. And it's all the fundamentals of real estate. So when it comes back to that, it kind of is real estate. But we decided that we thought there was an opportunity. We bought the assets that we sold to SuperValue back last year in a very difficult transaction. And then, an opportunity came to buy Safeway and do a consolidation. And it's more of a synergy play than a...
You're being very modest, though. You guys worked the real estate very well.
We did. That's how we got 5.
Yes.
We got 5 times our money. And part of the reason is, again, I come back to the operations, because if you have good operations, it makes the credit underlying the real estate that much better. Yep. And therefore, we got a bigger multiple on trading out of the assets, whether it be a sell-leaseback, which we did 2 of those, whether it be selling assets that were,
one thing to understand about that business is it's almost binary. Like if you have a successful grocery-anchored center, the cap rate's very low. If the anchor goes out and blows and it's non-anchored, it's...
Yeah, we had a bunch of those centers.
The value
we closed stores.
Is completely different.
Yeah. So I'll give you a good example. In Florida, when we sold in the first batch, we had 100 stores. We sold 50 of them to Publix for almost $10 million a shot. And the other 50, was about $3 million a shot as we liquidated them. So that, emphasizes Adam's point. you had an operating, really great located stores that operate, that Publix was gonna, and they do a pretty good job with their stores. And then you had all this other stuff which weren't so great and not so great locations. And to reproduce one of those stores, the land is about $15 million a pop. So we're selling them at 60 cents on the dollar. Yeah. And we bought them at 20 cents.
It was interesting, and I don't think a lot of people in the real estate business really focused on this. By controlling the tenant, they were able to create a lot of value. So if you have a grocery-anchored strip that's got 2 years left on a lease, no one really wants to buy that if they don't know what's happening with the tenant. These guys, when you control the tenant, you could buy the underlying land for cheap because no one wants it with 2 years left. Then you extend the lease, and you've created all this real estate value. I mean, it was a very strong strategy.
What we did. So
yes.
I was being a little modest, but.
So I'm going to ask one more question and then open it up. So please, if you have any questions, approach the mics. But one of the things that I sort of wonder about and think about is, what are the disruptive forces that are out there that we aren't, thinking about? Whether it's technology, like we're going to be 3D printing everything and that's going to change industrial fundamentally, or energy is going to totally adjust the way we do things in the U.S., or the demographic shifts just globally from urbanization, or whatever it might be. But what is out there in your mind that is a disruptive sort of element or force that maybe we should be paying a little bit more attention to?
Millennials are weird. No, I mean, not just how they work and we work and they work and that I mean, like, I can't imagine anything worse
us
than
against them. Wow.
What's that?
I said us against them. I wouldn't have.
I couldn't imagine sitting at a desk with a bunch of people I don't know and like thinking that's a cool work environment, right? I mean,
but that is one of the hottest sectors. Is exactly what Sonny just said. Is having these incubator / common workspaces, and there's a couple of those companies that are really hot right now.
So I think it's technology, but it's culture, and it's how this new generation, who all of you are, well, there are a lot of old people out there too, but like us.
Older.
But all the students out here for sure are part of that, a part of that cohort. It's just a very different, it's very different. I think that just the way you all work and the way you live and the way you shop and all that is just very different than, honestly, I think any of the changes in the generations for the couple of generational changes before that. I think it's kind of cool, but to me, it's a little bit scary. Like I have a couple, my kids are a little bit younger, but they're teenagers, and I see it. I see it at home, and it's going to be, to me, it's very interesting. Look, and I think that, I don't know if it's a disruptive force or not, Matt, but I think that it's, there are a lot of things that are spurring urbanization around the world. I think that as I think about the U.S. has been a country that for a number of years now has been unurbanizing, if that's a term. I think it's starting to re-urbanize again, right? Whether it's the aging population bringing people back into cities. Millennials don't want to live in the suburbs. They don't want to work in suburban office buildings. They don't want to shop in strip centers that are in the middle of nowhere, right? I don't know if that's a disruptive force, but I actually think that this is one that it's so powerful. And when you combine it with what's going on from an aging population standpoint, I think it's actually pretty interesting. I think you're going to see U.S. cities grow very significantly. I think you're going to see urbanization accelerate in the U.S., and I think suburbs are going to continue to die a slow death.
It's also happening in Europe, too, in the major markets, places like Berlin, and you're seeing a lot of gentrification, and even in London. And those major markets, it's the same phenomenon that Sonny's referring to is happening. So I agree. There was an article in the New York Times last week about that exact issue about people leaving the suburbs and aren't coming back, and so it's really impacting.
New York Times too liberal for me, so I don't read it. But
Yeah, well,
if it was in the New York Post or the Washington.
I don't read the New York Times other than I scan, so I agree with you 1,000%.
And Matt, if anything else is more disruptive than that, we're a bunch of dumb real estate guys. We would be tech guys or private equity guys. We wouldn't know the rest of it.
It's funny. Certain things may be disruptive, but everyone's talking about. The impact of the internet on retail. I mean, that's talked about ad infinitum. So to me, partly what you want to try to think about is there anything out there that people don't recognize? You know what I mean? So the only thing I could think of, I was at this presentation at MIPIM, and a demographer came and spoke to us. And I guess I hadn't really focused on it, but one of the things she said in Europe, in the year 1900, there were 17 people who were 100 years or older. And in 2000, there was 1.7 million people who were over 100 or over. And by 2050, 50% of the population is going to have a life expectancy of 100. And so, you know, it has all sorts of implications for...
So you're pretty young, Ron, in that context, actually.
So, you know, it has implications for housing. It has implications... By the way, most of us raise our money from pension plans and those kind of things. So, you know, how do the pension plans fund themselves and pay out money if it's going to be for 40 years instead of, you know, 20 years? So, you know, it's... I'm not sure...
Most companies don't have pension plans now anymore. Everyone's on 401ks and,
yes,
and
on the
other
private
things,
sector,
so that's, well,
yeah.
but that's...
Yeah. So, and if you look at some of these places, you know, Japan, which was mentioned by Sunny, Germany, you know, the populations are decreasing. You know, as one of the things the demographer said, as the mortality rate decreases, so does the fertility rate. So you're getting these real weird imbalances in a lot of these places. And China's had, I think for 39 years, a one-child policy.
They just
so,
changed it.
You know, that has a huge impact. And I was with some guys from China last night, and they were saying by 2030, they're going to have over 600 million people retired. You know, and it's 1.3 billion people in the country. So it's a huge, huge drag on the economy. So, you know, I don't know if that's...
And they're going to have a food shortage. I'm sure they didn't mention that, did they?
So anyway, you know, in terms of things that I'm not sure people are totally taking into account, even though it's, you know, it's there in the numbers, this fact that, you know, better medical technology, better nutrition, exercise, that combination is causing, you know, a lot of people throughout the world to live much, much longer.
So we'll open it up to the audience. Anybody? Great.
I'm Caspian from the School of Foreign Service. I've been reading about Chinese investors coming to Detroit and buying up some real estate there. Is Detroit an untouchable city? Are there some places after the recession that you just can't touch anymore because, you know, too much risk?
You mean untouchable from our...
your perspective. The Chinese will take it because, you know, they have nothing else to buy. But, you know, would you touch it?
Would we touch it? Yeah, we've looked at it. I mean, I haven't found anything that's that attractive. It is a declining market. So
I think if you have a choice of investing places, right? So part of it is like we're all in businesses where we've got a mandate which is pretty broad, so we don't have to do any one thing. You know, so I have no interest in Detroit. I don't even want to visit, right? So, but
unless it's the Detroit City Police or something, you give them money.
But
they don't have any money.
Yeah.
No, but
that's true.
They're bankrupt. Come on.
No, but I'll tell you what I like about.
That's
but what's
true.
cool,
That's the problem.
Yeah.
But what's cool about real estate is you can make money anywhere, right? I mean, people can make money at it, right? It's such a local product, right? People still live in Detroit. They're still shopping in Detroit. There may still be some office tenants, I think, in Detroit.
Yeah, there are.
Right. So if you buy something cheap because you get it cheap and you do a really good job of repositioning it and you offer the best product in the market and you can do it at a low cost because your basis is low, you can probably make money at it. But why bother if you don't have to? So that we're allocators of capital, so we don't have to bother. But I'm sure that Chinese guy you're talking about that bought that thing, I remember they interviewed him. He's like, someone paid $300 million to build it. I bought it for $12 million. I have to make money. Maybe he'll make money, or maybe he'll lose $12 million.
Or a lot more putting up trying to get there.
I was going to say one other quick thing on that, and it's not so much relative to Detroit, but just conceptually, when you think about investing, I think it's a lot simpler than people kind of make it. I mean, you have really two things. You have your income, and you know, how do you underwrite your income stream? And if your income stream is going up, it's generally, you know, a good thing. And the second thing is your price you bought it, the price you're going to sell it. And so if you could find situations where the income goes up and the cap rate goes down, that's a very powerful combination. So you're kind of looking for those kind of opportunities where you can. One of the things that's hard in the US today is cap rates are very low, and you kind of have to get there through the income. You got to be pretty bullish on income to get there, because you don't think there's a lot of cap rate compression left. So in my mind, the questions I'd ask on a Detroit is, in a city that's, had declining population and declining industry and all this stuff, is, are you going to be able to grow the income, and is the exit cap rate going to be lower than when you got there? So,
And what's the risk to get there?
yeah, and so, right, which kind of helps you determine what kind of return you need.
And is someone going to steal your car while you're doing due diligence?
But I think in a sense, if you always bring your investing to those kind of basic principles, and beneath that, there's a lot to underwriting income, obviously, but you have to kind of think about it in those, two basic things, because that's really what drives return. Sir?
Two things. One, two very separate questions. I guess going back to the issues or disruptive, when you think about brick and mortar, it just seems like that doesn't seem to be the place where you might want to put all of your money from a standpoint of now the internet, so if you're a store, how many stores sales are going down because everybody's buying things through the internet, like you say with the millennium. So is that something that people, is that going to be a long-term issue, or is it going to be sort of weighed out because of the folks getting older and then we're going to need more old folks homes kind of thing? And then second of all, as Barry enters the room, does anyone want to say anything about the hospitality industry or the hotel part of that business from a land and owning those assets?
I can answer retail. I have a little bit of experience. You could spend, a whole session on the internet and what the impact is. I would say the current thinking of everybody is that, yes, the internet's going to continue to grow. It's going to continue to improve the experience, but the physical bricks and mortar has responded, and people are improving that customer experience. People are social. So to the extent that they have a good experience and they enjoy the shopping, it's social, it's whatever, that they'll be able to coexist. And retailers, the catchword today is called omni-channel. And so the retailers are coordinating what they're doing. I had a conversation 3 or 4 years ago with Blake Nordstrom, and he said when they coordinated their inventory from the store to the online, people would browse online, and then they'd come into the store and actually help their sales. So I think the retailers who deliver a good shopping experience will continue to do well. But the internet's here to stay, and it's not going away, and it's going to continue to, I think, outpace total retail sales and growth. And the question is, where does it ultimately level out? And a bunch of retail will probably be obsolete, but to the extent you deliver a good customer experience,
Probably not the high street stuff, right?
Yeah, I think the high street.
The urban is.
Yeah, people enjoy that.
People want to go there, and they'd like to order it online and pick it up at the store. It's more convenient. So.
But there's obviously a lot more to say about it than just that.
Yeah.
Hotels are very correlated to GDP growth, right? So I think that RevPAR, if you look at RevPAR, it went down a lot, and it's up a lot. And so it's a big country, forget the rest of the world. There's probably still places where there's an opportunity to make money in lodging, but I also feel personally I think lodging is getting late in the cycle, from the standpoint of where RevPAR is, and Adam said cap rates aren't going any lower.
One thing I will say about hotels as an asset class is people have made an enormous amount of money on them, but they've also lost a lot of money on them. Because hotels have basically, both operating leverage and financial leverage. So when, they're full, you're making a boatload of money, and when they're empty, you could make zero, because you're fixed costs. And so what happens is, if you're buying them on kind of depressed earnings at high cap rates, there are certain times of the cycle you could do that. They're great. And, obviously the converse is true too.
And they typically lag the economic cycle too.
Yeah. So anyway, I think if you're a good timer, you could make a lot of money on hotels. Sir?
Bricks and mortars was also one of my questions, but I do have another one, which goes to each of you. Are there particular cities that are providing attractive investment opportunities right now, and why?
So my single favorite city to be investing in right now is Tokyo, because...
U.S. cities, I'm sorry.
Oh, U.S. cities, shit. I actually like L.A.
So do
And I'll tell you why, because we actually only invest in 5 cities. So we invest in New York, Boston, Miami, San Francisco, and LA. I tried to invest in DC, but you people are too crazy.
You're not investing in Tennessee?
Not investing in Tennessee. I don't even want to visit Tennessee again, right? So, so the issue is that New York.
Nashville.
Yeah, it's a nice place to go to like see some country music, but. So, you know, New York, we've talked about before, it's expensive. Boston's a small city. It's actually gone up a lot. San Francisco's almost wacky now, right? Miami is, you know, the national bird of Florida's. Miami's the crane again, right? There's so much development going on down there. It's crazy, right? So,
That's a good one.
I like LA because it's lagging. It's lagging all those other cities. So you could argue parts of LA are a big suburb, and yet other parts of LA are just really interesting. You look at downtown LA, which is completely different than I lived in LA in the early. I knew God did not intend me to live in LA because I moved there a month before the riots, and I left a month after the Northridge earthquake, and I said, screw this, I'm just going to visit from now on. But when I lived there, downtown LA was scary, right? And now downtown LA is vibrant. It's the, you know, and I don't know what the cool parts of Washington, D.C. are, but it's the Williamsburg or the, you know, the cool downtown markets in New York City. Downtown LA is great. It's where the millennials are living. There's all kinds of stuff going on. So I just feel like it's earlier in the cycle. I think there's still more upside left in LA. So that's probably the place where on the margin we're spending the most time.
So if you don't mind, I'd like to jump to the gentleman behind you, and that be the last question, because we got to move on here.
Hi, my name is Evgeny Lebanidze. I'm an MBA student here at MSB. Thank you so much for being here. My question is, all of you have mentioned that there's a lot of liquidity out there right now, so there's a lot of capital. So my question is, you know, how do you kind of look for that maybe proprietary deal? And what kind of unique value might bring to the table in terms of how you structure the deal or something else to kind of get a leg on that competition?
You drink a lot, try to get the guy to sign the contract when he's done.
Well, I'm glad these guys are on opposite ends of the spectrum here.
Well, I will argue that there is no such thing as a proprietary deal for the most part in the U.S. Now that's a big generalization, but I know we all go to our investors and, you know, we say, oh, we have all this proprietary. I haven't seen too many proprietary deals get done. Most assets are traded in an auction basis here in the U.S. And you know, anybody can agree you can disagree with me, but that's pretty much why all the brokers are making a ton of money right now. And because they are auctioned off and they want to get the highest price. And you know, that's what differentiates. Now, if the asset's a lower quality, you know, maybe there won't be as many buyers and you don't need to do that. So then it could be more proprietary, a busted deal. That happens.
Yeah, I agree with Ron, to be honest with you. And you know, there's a lot of people in our business who talk about we only buy off market, we don't, you know, compete in auctions and blah, 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 blah. I focus much more on what price you're paying and what returns you're getting, and it doesn't really matter how you got there. So, you know, if we're in an auction or not, if you like your price, you like your price. So, and I don't mean to be too cynical, but I kind of agree with Ron. Is what I've seen a lot of times these off-market deals are semi-marketed anyway. So there's dynamic tension in the process, regardless of the fact that it may not have been an e-still process. So
not to advertise any one group.
Right.
Well, I think we're out of time, but gentlemen, thanks very much. I appreciate it. Great insight.